back. New economic data released this morning shows that the U.S. labor market remains resilient despite mounting economic uncertainty in that country. Our next guest believes investors should be taking advantage of opportunities in the U.S. agricultural and healthcare sectors. She also thinks the U.S. IPO market will pick up steam later this year. We're joined now by Kim Inglis, portfolio manager at Inglis Private Investment Counsel, Raymond James. Kim, always great to have you with us. Why don't we start with this market rally we've seen so far this year across really all developed country stock markets around the world. The S&P TSX Composite here at home is now only 6% off its all-time high.
Yeah, well, I mean, after such a dismal year in the markets, I think that people are looking for any opportunity to see some positivity in the market. So I think that rally has been largely sentiment driven.
Let's move on to opportunities that you think exist in the U.S. market. You've spoken to us in the past about ways to play the agricultural farmland space. What are your thoughts there?
Sure. I mean, I could talk about agriculture until the cows come home. And it's one of the areas where I think there's a lot of opportunity. You look at farmland as an example. I mean, the case there is basic supply and demand. We've got a lot of mouths to feed in the world, not a lot of farmland. You look at the U.S. and just about a fifth of the available arable land is actually farmable. And so, it's just not available to people. Farmland as well is a great investment in terms of the fact that it's uncorrelated to the market. It's tended to outperform the S&P 500 over the last 20 years, but at lower volatility. It checks off the ESG bucket for investors that are looking for that. And from an inflation standpoint, it's been a good one. If you look at it during the 1970s, it rose in real terms 275% over that time, and was one of the only assets that actually beat inflation over that time. The agriculture sector as well is really interesting from an ag tech standpoint. And again, that kind of comes down to the fact that there's just not a lot of farmland, so the agriculture sectors had to get a lot more creative with things, doing things like vertical farming, so you're growing upwards and needing less land, and no-till agriculture, so needing less fertilizer and that sort of thing.
So as you've been speaking, we've been showing a graph of the iShares Global Agricultural ETF, ticker symbol COW. Top holdings, Archer Daniels Midland at a 10% weighting in that ETF, Corteva at a 9% weighting, Mosaic, the huge fertilizer company, at 7%. Other names in the top 10 include Tractor Supply, CF Industries, and Deere. Do you advise a broader weighting to agriculture as this ETF would give investors?
Yeah, so I mean, I think, the agriculture sector in general has a lot of opportunity, not just now, but over the long term. So getting a diversified exposure to it through an ETF, so more of a broad approach to things, is a good one. And that one, as you mentioned, it's globally diversified, so that can give easy access for investors into the space.
And we saw that the one-year performance of that ETF was a positive 9% performance, approximately. That there you have it, positive 9%. You can see in the top right-hand corner of that graph. That stacks up to a one-year performance on the S&P 500 in the United States of negative 10%, very nearly. So the difference is close to 19% outperformance between, again, that ETF on the upside and the S&P 500 on the downside. Let's move to healthcare. You've got an ETF in this space as well. Why do you like the healthcare sector in the U.S.?
Yeah, so the healthcare sector, I mean, over the short term, it's a bit more of a defensive sector to be in. It's lower beta. It tends to have a cheaper valuation right now. Right now, it's trading around the midpoint of its 10-year PE range, which is actually better than some other more defensive sectors like utilities and consumer staples and that sort of thing. From an earnings perspective, it's got very little earnings risk there relative to other sectors. This latest earnings season, it's third highest in terms of earnings per share. Surprise. which is interesting because the price reaction to it during that time has been about half of what the price reaction's been in the S&P 500. So good opportunity from a short-term perspective, but from a long-term perspective, I mean, it boils down really to a demographics issue. We are all getting older, whether we like it or not. And, you know, as you get older, you've got more health issues, and, you know, you need healthcare to provide you with the medications and the treatments, that sort of thing. So.
The gains have been substantial in that ETF. We showed the iShares U.S. Healthcare Providers ETF. Top holding here is United Health Group, with almost 1/4 of the ETF of the value of the holdings of the ETF invested in that one stock, United Health Group. Then comes CVS at almost 14%. The gain there over the past year is north of 30%. You believe there's more upside here, do you?
Well, I think it's a long-term investment. It's something that people should park for a long term. It's you know, as you mentioned, it's more insurers and providers, which essentially are the companies that are providing aging seniors with their services. So it's
I haven't left enough time, I don't think, to talk about IPOs, but you do believe the UPS, I'm being given permission to go for it, so let's go for it. You have an ETF here as well. You believe that the U.S. IPO market will pick up in the second half of this year. That's often considered a real barometer of sentiment, of course, in the market. And indeed, there's an ETF that offers investors exposure to companies that have IPO'd within the previous 5 years, I believe. Let's talk about IPOs.
Yeah, so I mean, IPOs had a record year in 2021 and then an absolutely dismal year last year. Global volumes came off 45%. US IPO activity, worst it's been since the financial crisis. So terrible time last year for IPOs, but analysts are expecting it to come back. Some of that activity to start trickling in the later half of this year. And that's really because companies have been sitting on the sidelines. They've been waiting for consumer sentiment to get a bit better so that IPO, interest in IPOs will increase. And that correlates well with, seeing interest rates, inflation, seeing that rolling off and that sort of thing. So that particular ETF is a good one because it actually used to be called the US IPO ETF. And it basically gives you exposure to the 100 largest and most liquid US IPOs, and it's reconstituted quarterly. So basic, premise behind that is that you're always getting timely exposure to IPO activity.